this is a topic that we could, both of these topics, both estate and tax planning, just the basic side of it, and one big beautiful bill is something we could probably talk about for like 4 hours if we really wanted to. I think what I'm going to try to do today is, presentation on estate planning. I want to give a couple of additional thoughts on things that you can think about moving forward, especially if you have children and grandchildren. Or you have a blended family, because that seems to be something we get a lot of questions about these days. Like, what happens if I'm on my second or third marriage, or what happens if my kids are on their second and third marriage? Like, what happens if they have stepchildren? The blended family is becoming a much bigger deal these days than it has in the past. So we get a ton of questions about it. So I think it's important. So let's just talk about core estate planning documents for people that can't see it over here. I mean, essentially, when we say core documents, what we're talking about is your will.
Yeah.
If you have trusts, either revocable or irrevocable, the power of attorney, which can be both financial and healthcare. It can be general durable power, which is both, or it can be a financial or a healthcare power of attorney. I would say, I mention every year that there are different types of powers of attorney. The two main types would be springing and durable. Springing comes into action or into effect effectively whenever there's some sort of an event that occurs, an incapacity, something triggers it. I think myself and my firm, we steer clear of those for a lot of reasons. We just don't ever want to define what that is. So when naming an agent under power of attorney, this is something that I think power of attorney documents are actually the most important part of your estate plan. A lot of attorneys might disagree with me on that, but you're still alive when they're being used. And if you can't make decisions for yourself, you better name the right person to make decisions for you, because who really cares where your stuff goes after you're dead? You should be more concerned about who's making healthcare decisions for you while you're still alive and can't do it. So for all of you that do not have a power of attorney document, especially a healthcare one, I would encourage you to do that immediately, because we run into lots of problems with that. But a living will and advanced healthcare directives, also very important documents. They allow you to exercise your right of self-determination. You can basically say what type of care you want to receive in the event of a catastrophic injury, something end of life care. If you can't speak for yourself, that document speaks for you. There's also things called POLSTs in Pennsylvania order for life-sustaining treatment. Only a doctor can fill those out. They're bright pink. If you've ever seen one, they're usually on a refrigerator or a bedside stand. That's where you would find them. The general requirements are terminal illness on those. And again, lawyers can't do that. It's got to be done by a physician. But they are very helpful. If you have business, if you own a business, obviously, I'm just going to mention this. They're not really part of your estate planning documents, but they're ancillary too. So making sure that all of your organizational documents are intact, whether you have a buy-sell agreement or you have transferability restrictions or cross-purchase agreements, anything like that, you should revisit that. If you're updating your estate planning documents, I would take a very close look at, can I even leave the shares of my company or the membership interest in my company to my kids? Do they have to, can they be left in a trust for my spouse's benefit? You should read those sections extremely carefully, because they do have an impact. And we have a lot of people that come in, we look at their documents and they are bewildered when we tell them that they say something completely different than what they think the documents say. So from time to time, your business partners, your family, whoever you're in business with, should definitely take time to look at those. So estate planning for the modern family. So when we talk about modern family, it's not necessarily talking about you and your spouse that are sitting here tonight. It could involve your children. A lot of times what we use is, this is where trusts really kind of come into play. If you own a little bit of just background on how estate planning works, the difference between probate and non-probate property. Anything that is either joint tenants with right of survivorship or tenancy by entireties, which is spouses owning something jointly, it automatically transfers upon the death of one of the joint owners or one of the spouses to the surviving joint owner or the surviving spouse. Why is that important? If you are on a second or third marriage and you may not want to leave everything to your spouse, but you may want to take care of them for the remainder of their lifetime, you probably don't want to leave it to them as a joint tenant with right of survivorship or a tenancy by entireties. Why is that? If they have their own kids from a prior marriage or before the marriage to you, they can inadvertently, if they don't have their own estate planning documents set up correctly, leave all of your assets to their kids. That may not be what the result that you're looking for is. Same thing goes with kids that are on a second or third marriage and have children of different marriages. As parents, you should be taking that into consideration when you're doing your own estate planning for your children, especially if you believe that they can't be trusted to make the right decision or go see a lawyer. You can effectively control that from the parental level. So your kid's inheritance can be controlled by you. I mean, it's dead hand control with a trust, but you can dictate essentially which one of their descendants it goes to and which ones it doesn't. So if they've got unadopted children from another marriage with their new spouse, and you don't want it going to them, you as the parent can control their inheritance if you want to do that, if you want to take those steps. It's an important consideration. The choosing of fiduciaries also, if you're going to do it the trust route, put a lot of time, effort, energy into picking the right person. Same thing goes with the power of attorney. Pick the right person to make the decisions for you after you're not there. Stepchildren are unique. That kind of ties into the whole discussion here, is that if you are on a second or third marriage and you have stepchildren and you want to take care of those stepchildren, but maybe you don't want to take care of their children or other further down the line, the use of trusts, it's the way to do it. There really is no other way to ensure that there's going to be whatever your wishes are followed. The only way you do that is, again, via a trust and picking the right person, the right trustee to manage that trust that's going to, execute on the document the way that it's intended to be, administered. So business interests, I go back to this again too. The transferability restrictions, you have to read those carefully, because if you do own a business and you do want to leave it to either your kids or to a spouse from a second marriage or even a first marriage, you need to make sure that the organizational documents for the business allow for you to do that, because transferability restrictions are a real thing, and lawyers that draft these things a lot of times will just give you a form document. They may not even know what's in it. So you should definitely read that and revisit it from time to time. I just wanted to point this out again, the difference between probate and non-probate, making sure that you understand that non-probate property will transfer automatically, whether it's via beneficiary designation or joint ownership or in trust. The one of those that you can control what happens to it after it transfers to that beneficiary is the trust. Beneficiary designations that are outright designations or joint ownership, you lose complete control at that point, whether it is, again, to a surviving spouse that maybe a second or third marriage, or to a child that you don't want them to necessarily leave it to their spouse or to, their spouse's children from a prior marriage. It's a huge consideration. And like I said, I think I'm here tonight to just point it out that I've probably gotten 15 of these questions in the last 36 hours. So we hear a lot of it. It's every single day, multiple times a day. For Pennsylvania, we are one of, I believe now, 5 or 4 states that have an inheritance tax. An inheritance tax is different from an estate tax. So an estate tax is a tax on the value of your estate at the time of your death. That's like the federal estate tax. Inheritance taxes are slightly different from a tax policy perspective. They're actually a transfer tax. So they tax the transfer of assets from your estate to the donee, whoever's getting it. And the tax rate is based on the relationship with that person to you. There are some state, well, there's one state, Maryland. So if any of you live in Maryland, you should probably talk to an attorney. We are licensed in Maryland and DC and Virginia. But you should talk to somebody immediately, because the whole Maryland issue is they have an estate tax and they have an inheritance tax, and they do overlap. And if you own property in Maryland and you're a Pennsylvania resident, you should definitely talk to an attorney also, because Maryland's estate tax is a much lower threshold, and I'll get to the federal side, than the federal estate tax. Their threshold is $5 million. And if your estate is over $5 million, Even though if you're not a Maryland resident, it could pull part of your Maryland property, non-resident owned property into, you could owe tax money to Maryland, even dying as a Pennsylvania resident if you own real estate there. We see it happen a lot. There are a ton of attorneys that don't pick up on that. In this area, there's not a lot of attorneys that are dual licensed in the DC metro area, especially. And a lot of people have beach houses in Ocean City, Maryland, and Fenwick and all those other places around here. And somebody dies, and then they go turn around, try to sell the house, and then the state of Maryland puts a lien on the house for the estate tax due. It could be a little bit of a mess, and it's a shock. So if you fall into that category, you should definitely talk to somebody just to see again, over $5 million gross estate and property in Maryland. Delaware, fortunately, you don't have that issue there. They don't have estate or inheritance taxes. So if you're in Delaware like me, you got a and same thing with New Jersey too, by the way. New Jersey's a very light death tax jurisdiction. So Maryland's the one that we kind of focus on now. Yeah, the only other, so New York does have an estate tax. I'm just looking to see the list here that's close to us. Even if you own property in New York, New York's estate tax exclusion is a lot higher, and I don't believe they enforce it against lineal descendants, so children, grandchildren, spouses, obviously. So the spousal use trust, let's talk about this, where it ties into what I was mentioning about spouses, a trust for a second or third spouse. A spousal trust in Pennsylvania doesn't trigger inheritance tax due until the spouse beneficiary dies. So if you leave something in trust for your spouse, your surviving spouse, even if your kids, so a lot of times what we use are what called QTIPs, qualified terminal interest property trusts, spousal trusts, for short, really. You can leave an asset in trust for your spouse, and if they're much younger than you can allow them to benefit from that for the remainder of their lifetime, as long as there are no other potential beneficiaries of that trust. And when they die, then inheritance tax is due, and it's based off of the rollback or who it goes to, the remainder beneficiaries. So if they're your children, so you can say, I want my spouse to be taken care of for the remainder of their lifetime. And when they die, I want it to go back to my kids, so they can't leave it to their kids from another marriage. That trust is going to be largely inheritance tax exempt until the death of the second spouse. There are lots of exemptions in Pennsylvania for inheritance tax. And just so you guys know, the rates are 0%. There is an actual rate for spouses. It used to actually be much higher, but Pennsylvania transfers to a surviving spouse or a spousal sole use trust is 0%. Lineal descendants, 4.5%. So children, grandchildren, great grandchildren, and parents up the line. If you go over to a sibling of the decedent, 12%. And if you go to anybody else, nieces and nephews, it is 15%. And it is effectively from $1. There are a few exclusions, but it gets pretty onerous when you're leaving your entire estate to nieces and nephews. There are exceptions to that, except the big one being life insurance. A life insurance policy left directly to beneficiaries, or even if it passes through the estate, you can still claim exemptions on Pennsylvania inheritance tax. I would say that if you are leaving assets to people in your life that are in the 12 or 15% category and you have children, it's very important that you take into consideration when drafting estate planning documents, in particular your will, how the tax is paid. There's a thing called apportionment in Pennsylvania. Who pays the tax? Is it paid out of the residue of the estate on all of the taxable assets, or is it paid by the individual beneficiaries? There's a difference between the two, especially if you have a bunch of 4.5% beneficiaries and or a few 15% beneficiaries. The 4.5% benefit, if the tax clause in your documents is not correct, they could end up picking up the tab. The 4.5%, the children could pick up part of the tab for nieces and nephews that take assets from your estate. A trick that we use to get around that is the use of life insurance. If you've got a niece or a nephew and you want to leave them something and you have a life insurance policy, you can leave them some or all of the proceeds of that policy. It will go to them tax-free. I have businesses again on there. You got to be really careful with businesses. They do value businesses as tangible property in Pennsylvania. Stock in a company, membership interest in an LLC, that is tangible property for tax. Everything is basically subject to tax in Pennsylvania. So there are very, very few things that are not. Interestingly enough, if anybody works for the legislature in here, the legislative retirement accounts are not subject. They've carved that out for themselves. So if you're looking for a job, it's very, very useful to go get a job working for the PA legislature because it won't be taxed when you pass away. Pitfalls, the biggest pitfalls that we see a lot of times are when somebody passes away using a CPA or a non-attorney to administer the estate. It is the unauthorized practice of law in Pennsylvania, although lots of CPAs will tell you they can administer estates and they will try to do it. They will literally do it wrong every single time. I've not seen one that actually worked out correctly. They will not do calculations correctly. The Pennsylvania inheritance tax return is an extremely difficult and extremely complex document. Pennsylvania has a lot of, I don't want to say loopholes, but there are a lot of opportunities to take advantage of Pennsylvania's inheritance tax, law that only really specialized attorneys understand. I would also tell you that if you're using an attorney that charges a percentage of the total estate, I'd probably question that at this point in time too, because it's very uncommon to see that. We've seen literally everything at this point. We've been called in to file appeals. I've even probably done it for a couple of Doug's clients over the years, I think, where we've had to appeal to Pennsylvania Department of Revenue because somebody tried to do an inheritance tax return and had no idea what they're doing. I only say that just to emphasize, if you're going to pay somebody to do that, pay the best possible person to do it for you. Do not, if a CPA says they can do it, don't do that. It's a very, very, you're doing the beneficiaries as an executor a disservice. If you are a beneficiary, you're doing yourself a huge disservice. It's just it's not a good idea. This, in contrast, though, is the federal estate and gift tax and generation skipping. Federal estate tax is something that everybody thinks about all the time, but it really only affects a few people. It's not, right now, going into 2026, the exclusion per person will be $15 million per person. That is up from historically much lower, $5 million, what it was before the Tax Cuts and Jobs Act. It's very misunderstood. Federal estate and gift tax is referred to, you have a credit, it's referred to as the unified credit. And everybody says, okay, look, I want to give away money before I die, but I can't give away more than $19,000 per year to somebody without having to pay tax. Not true. You can give away $19,000 to every single person that you know and not have to file a gift tax return. If you give away $19,001 to one person, you have to report all gifts on that gift tax return under the law. What does that mean, though? If you give away $19,000 and $1 to one single person, and then you give $19,000 away to 10,000 other people, you've only used $1 of your credit at that point, of your $15 million credit, I should add. So if somebody is sitting in this room tonight and they're thinking about making gifts to their children or their grandchildren or to trust for the benefit of their children or grandchildren because they just plainly don't need the money anymore. And by the way, we do encourage lifetime gifting. It is, for Pennsylvania inheritance tax purposes, very helpful. They only go back 1 year after you die. So any gifts made before 1 year aren't pulled back into your estate. But for federal purposes, you don't have to worry about it if you don't have over $15 million as an individual or $30 million as a married couple. And you can give away and or die with some combination of that and not pay a penny in federal estate or gift tax, which is a 40% tax. But if you do go over that amount, every dollar over that is subject to a 40% tax. Technically the estate tax is a progressive tax. It just doesn't kick in because the exemptions are so high until it's at the 40% level. But it's not a tax that you want to pay, but if you have to pay it, it usually means you have a whole lot of money. So, but people that do fall in that category work very hard to not pay that tax. Generation skipping, transfer tax, just to put a point on that, actually, you can give away more than $19,000 to any person that you want. If you want to write a check and give money to a grandchild for $100,000 or put it into a trust for the benefit of a grandchild, it's only going to use some of your federal credit. There will be no taxes due unless you've already given away tens of millions of dollars. So you have nothing to worry about. That is a very common misconception. Generation skipping transfer tax was a tax that was put in place to stop the the dynasty families, mainly the DuPonts and the Rockefellers. It is a tax on skip generations. So if you try to give money to a grandchild and their parent, your child is still alive, it uses what's called your GST credit, which is equal to your federal estate tax. They run parallel to each other, but you could inadvertently, if you give away too much money to a skip generation, and it's also a 40% tax, you could end up paying 80% tax inadvertently. But you would have to give away a heck of a lot of money. So that's usually not an issue. For anybody that is in a situation where they have a married couple is, over $10 million, $12 million total at this point, we would encourage them, typically the surviving spouse, to file a Form 706 federal estate tax return, not because they are going to owe any tax, but because we want to preserve the deceased spouse's credit. That $15 million credit, whatever they don't use during their lifetime, can actually be transferred to the surviving spouse. So again, I think the point I wanted to make with this is Pennsylvania inheritance tax is actually a much bigger problem for most people sitting in this room, probably every single person sitting in this room. Federal estate tax, if you listen to, I don't care if it's Fox or CNN or MSNBC, around the time that they're doing these tax bills, everybody's howling about it. And it really only affects, a couple hundred people a year, maybe at most in the United States. I mean, legitimately, most people are, or maybe 1,000 people a year. Most of the people that fall into that crowd have already hired lawyers like us to do all the planning, and they don't pay much, if any, federal estate tax. It's a very, 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 very small amount of the federal budget. But, a lot of people think because politicians and talking heads on TV think it affects them. It really truly does not. It doesn't affect you as a taxpayer by increasing your taxes when they increase the exclusions, because the actual collections at the federal level are almost, I mean, they're a rounding error at best in the federal budget. So, the benefits of having a trust for the benefit of a surviving spouse. Again, most spouses own everything jointly, and it will pass automatically to the surviving spouse upon the death of the first spouse. So it's very difficult to unwind that unless your spouse agrees to unwind that. There are reasons to do that, but there are also reasons for us to include what are called bypass or credit shelter trusts inside of your will for tax planning purposes. This right here is something that we use, and I just wanted to put it out there so that you've heard it. You can easily Google this. You can read about it on the internet. It's a pretty complex planning technique that can be used for people that don't have federally taxable estates, and we use it for a lot of different reasons. One of the main reasons we would use this is if you have an asset that, if your spouse has passed away and you have the right provisions in your spouse's will, and you have an asset, say like a piece of investment real estate that you think is going to appreciate a whole lot over the course of your lifetime, you can effectively choose to pay Pennsylvania inheritance tax on it right now, still benefit from it for the remainder of your lifetime, and when it passes to your kids, have no tax owed on it at the increased value. That's important. So, this is a very, very, very specific set of circumstances that comes into play. But like I said, I wanted to include it in here because it does come up, especially if you have real estate, especially if it's investment real estate. There's a whole bunch of different types of planning strategies we have. Again, I put this in here so you can Google all of these things. You can go on AI. It'll tell you all about this. So you can go down the rabbit hole and read for hours. The importance of this slide is that there are lots of different options for lots of different situations that come up. We can create spousal trusts, like I talked about. We can create trusts for your children that make it so that they are the owner of the trust for income tax purposes, but they don't get to say where it goes when they die, so that they can't inadvertently leave it to a spouse who then could leave it to children that are not your grandchildren. If it was a second marriage situation, we have lots of options. I throw CRTs, charitable remainder trusts, on there. For those of you that are charitably inclined or looking for income tax deductions, CRTs are a great tool for doing that. They're also a great tool for leaving assets to a child who will get like basically an income stream off of it for their lifetime. But when they die, whatever's left over goes to a specific charity that you designate. Very, very, very helpful. There's something for everybody, trust me. So this is a really, really strange topic, mainly because we have a piece of legislation. So the legislative process, I'm not going to run through how it works. Suffice it to say, the House and the Senate come together on a reconciliation bill, and this is what they ended up with. This is one of the stranger pieces of tax legislation I've seen in recent years. Tax Cuts and Jobs Act was a little bit odd, but you had a House and a Senate that were both Republican back then, and a president obviously that was Republican. There were things in there that you wouldn't expect Republicans to put in it. There were a lot of things in there that shocked a lot of people. One big beautiful bill, the problem that we're running into right this second is it's so new that Treasury hasn't issued. So once Congress passes a law, especially a tax law, an overhaul like this, Treasury has to Treasury Department, which oversees the IRS, they have to catch up and they make regulations to basically fill in the gaps what the tax code doesn't, what the code itself that Congress has adopted doesn't cover. They haven't filled in those gaps yet. So we basically have like a stone wall with no mortar in it. And that's a bit of a problem for practitioners. And we're hoping that they hurry up and do that. But the government shutdowns making things a little bit worse at the moment. This is the newest information that I could get as of 9:45 a.m. today. So some of this stuff some of it came out yesterday. So it's coming out as right before our very eyes. Actually, every day we get new proposed regulations. All right, so we're going to hit four big topics here: businesses, employee benefits, estates, gifts, and trusts, and individuals. I should also add the estates, gifts, and trust has the fewest changes. It's just one change, actually. So that should show you what they spend most of their time on. All right, let's start with businesses and corporate donations. Everybody always wonders what, corporations get a lot of bad press, probably rightfully so, for some of their practices and some of their tax rates. They arguably are probably taxed at a lower rate than what they could be taxed at. And that's not a Democrat Republican concept. That it's more of a they have a lot more opportunity to take deductions. I'm not talking about small businesses. I'm not talking about your average medium-sized business in Pennsylvania. I'm talking about large publicly traded companies. There are ample opportunity for them to shelter tax dollars, basically, and not pay income taxes on them. I think most people, Republicans and Democrats alike, would probably agree it could probably tick up a little bit for large companies. And I think most of the tax commentators that are on both sides of the aisle would agree with that too. That being said, so when I say before and now, what I'm talking about is Tax Cuts and Jobs Act, one big beautiful bill. So both Trump administration bills it just so happened because he got elected for one term, skipped the term, and then got elected for a second term. It just so happened that the Tax Cuts and Jobs Act, which went into effect back in 2017, 2018, are now just expiring at the end of 2025. So a lot of this stuff expired or was set to expire at the end of 25. So they had to deal with it. I should also point out the fight right now over the shutdown is over medical insurance coverage that is set to expire at the end of the year. I mean, if you really boil it down, the fight is that the House Democrats want to see an extension of some of the medical insurance provisions. The House Republicans and the Senate Republicans are saying, no, that has nothing to do with the continuing resolution to keep the government operating. We'll deal with that. That doesn't have to be dealt with until the end of the year, or you're holding the shutdown hostage. They're deadlocked. I mean, it's going to be interesting to see who blinks first on this. I don't know really where I fall down on that argument, but this right here is an example of the shutdown is a perfect example of why government doesn't work, and the one big beautiful bill is also kind of an example of why our current Congress, there's a lot of horse trading that goes on. So a lot of this stuff that's in here, we don't know why it was put in here. We will find out eventually. So I'll just run through these. Corporate charitable donations. They can donate up to, well, before Tax Cuts and Jobs Act could do 10% of their taxable income in corporate donations. So corporations have basically business expenses, gross revenue less business expenses equals taxable income. That's basically how they're taxed. They have lots of deductions that they get though. There was no floor on it, meaning that they could donate $1 or however many dollars up to 10% of their taxable income and get a full charitable deduction for that. Now there's a 1% floor on it. They still have a 10% max, and it's the same exceptions that we had before. It's just certain farmers and ranchers and Native American corporations. So think like the casinos and things like that. They get special exceptions for this. There's carve-outs for them. They have very, very, very active lobbyists. All of this goes into effect though at the end of 2025, beginning of 2026. I should point this one out too, and I'm not going to do all of these. Small business stock. So this was a big one that everybody kind of debated. It's QSBS, what they call qualified small business stock. So certain types of companies that are in a qualified trade or business, which doesn't include personal services, if you are a C corporation or taxed as a C corporation, you can prior to Tax Cuts and Jobs Act, prior to the One Big Beautiful Bill, if you held it at a stock in a company that you basically started or you invested in, and you held it for 5 years, and the total value of that company was $50 million or less, and it was sold, you would pay effectively no capital gains tax on your sale. This is something that's been there in some way or another, even before Tax Cuts and Jobs Act. The reason that it's there, I think, is it's meant to encourage certain types of investments in certain types of industries. You might ask, what kind of industries are disqualified from this, Brian? I have an answer for that. Health, law, engineering, architecture, accounting, actuarial sciences, performing arts, consulting, athletics, financial services, Doug, brokerage services, or any trade or business where the principal asset is the reputation or skill of one or more of the employees, hospitality, farming, mining, and banking. Those are all excluded. That's a pretty broad list. There are exceptions to every single one of those that we're not going to get into. Suffice it to say, a lot of people are using this to avoid paying a lot of taxes right now. Now, post Tax Cuts and Jobs Act, any stock that's invested in after July 4th of 2025, if you hold it for less than 3 years, you get a 50% exclusion, okay, of your gains up to $10 million worth of gains. You get a 75% if you hold it for 4 to 5 years, and you get a full $10 million exclusion if you hold it for longer than 5 years. And that counts if it came into existence before July 4th of 2025. If it came into existence after July 4th of 2025 and you held it for more than 5 years, you have a $15 million exclusion now. So sales up to $75 million. So people can avoid paying a lot of capital gains tax when they sell and invest a company. It's usually startup companies, and they're usually tech companies. And that's pretty much it. It could be a tech healthcare company. It just can't be a hospital system. It could be, I only know this because it affects one of our clients, gyms. Gyms don't count as healthcare for some reason. And you could put a bundle of gyms together, build them up to a $50 million value and sell it and pay no capital gains tax. So for those of you that are looking for a new investment idea, you can come see us. We know enough about this to be dangerous, but I'm not sure anybody really truly knows a whole lot about this right now. That's a really strange section of the One Big Beautiful Bill. It was strange in the Tax Cuts and Jobs Act. It got more strange. Let's just put it that way. Qualified business income for those of you that are non-corporate. So if you own an LLC that's taxed as an individual, as a disregarded entity or a partnership, you probably see QBI deductions. You basically get like a 20% deduction against your taxable income that flows through to you. Arguably, I think that one's a pretty good one. It puts individual taxpayers who own small businesses kind of on similar footing to where big multinational corporations are. That was the intent of it, and I think it probably does that. Here's one that I know Doug and I both like. The bonus depreciation has come back. So before, if you put a, say, 6,000 pound gross vehicle weight car into service in your, financial or your law business, which is pretty much any SUV, you used to be able to deduct up to 100% of it after September 27th of 2017, which is when the Tax Cuts and Jobs Act went into effect. And then it started to ratchet down from 100. And then in 2023, it was 80%. 2024, it was 60%. 2025, it was 40%. Then 2026, it was going to be 20%. You could buy a car or some other asset that qualified for this, and then you could just immediately depreciate it. So starting now in 2026, or actually, I'm sorry, January 19th of 2025. So if you own a business and you buy a 6,000 gross vehicle weight car through that business, you can depreciate that whole entire car 100% bonus depreciation right now. So those of you that own businesses and need a new car, buy it through the business. That's not tax advice, by the way. That's just a suggestion. There are legal there are consequences if you do that and get caught trying to avoid paying taxes. But a lot of people do it. A lot of people do legitimately. Like Doug drives a lot. I drive a lot. It does benefit us to have the depreciation because we destroy cars. I'm putting 35, 40,000 miles on a car sometimes in a year. So some of the other really neat things actually that came with the Tax Cuts and Jobs Act, and which were kind of either built on / enhanced. The employer provided child care tax credit, the one big beautiful bill. So for employers that provide child care credits, they can, or child care for their employees, it increased from 25 to 40%, and it's 50% for certain small businesses. So the administration and Congress is trying to incentivize employers to start helping people pay for the very high cost of childcare. If any of you probably don't have children that are in daycare right now, I can tell you, having one that recently got out, it's about $18,000 a year. So it's not cheap. So they're trying to incentivize employers to provide benefits, which is not a bad thing necessarily. The paid family medical leave credit, they did expand that a little bit. Both of these only so the child care credit and the paid family medical leave credit, they only go into effect starting on January 1 of 2026. They allowed now, starting on January 1, employers can claim a credit. So credits and deductions, just so you guys know, if you don't know the difference, a deduction is a little different than a credit. A tax credit is more valuable than a deduction is because it's a dollar for dollar reduction in your tax liability, where a deduction is really just a deduction against your taxable income. So these are credits. So these actually do reduce an employer's tax bill if they pay for this stuff. So if you own companies and you're looking at doing this for employees, it's important to do this, to really dig into this. But so for the family medical leave credit in 2026, employers now can deduct the percentage of wages paid to the qualifying employee on family medical leave, or the percentage of premiums paid or incurred for family medical leave insurance. That is different than before. It's more beneficial. I believe the concept here is to try to get employers to offer medical leave and medical leave insurance. I think there's a reason for it. They messed around with the meals deduction again. So those of you that own businesses, check with your CPAs. There's a pretty big change that happened there. You may or may not be able to provide meals for your employees anymore that are deductible. It's that section of the code is a little bit hard to read, and they really haven't pumped out any regulations on it yet. So I would keep a very close eye on that. I briefly mentioned this, but they increased. So the Tax Cuts and Jobs Act increased the federal estate and gift tax exclusion from $5 million adjusted for inflation. It doubled it, so it went up to 10, and then it was adjusted for inflation. And then it climbed up into the $13 million range, which is where it's at right now in 2025. Well, it's almost $14 million in exclusion because inflation has kind of run it up. It was set to roll back or sunset at the end of 2025. as were a lot of these provisions that were Tax Cuts and Jobs Act, provisions in the tax code. What they did is now they've made increases permanent in a lot of places, or they've changed things. The federal, state, and gift tax credit is one that they made a permanent change. They didn't just temporarily extend it this time around. It is now permanently $15 million adjusted for inflation. What that means is there is no rollback unless there's a piece of legislation in the future that rolls it back. So it is there to stay. There is no more sunset. The planners, we were all kind of sweating a little bit because we weren't sure what was going to happen or if they were going to let it expire. It was a serious potential problem. They went one step further and made it permanent. So, I mean, I was not expecting that to happen, but they did it. So, that goes into effect basically immediately starting on January 1 of 2026. So that really does change things for people. That's really the only thing that they made a change to. And they'll index it for inflation. So it's going to go up from $15 million. So we'll be up to $20 million in the very near future. Unless, of course, the next administration comes in and Congress changes and then they roll it back. So they could do that too. And there's probably a pretty good high likelihood of that happening. Changes for individuals. If any of this stuff applies to you, you should talk to your CPA before April 15th rolls around. There's an adoption credit that they put into effect now that increased it. It's a refundable credit. So meaning you can go negative on your tax liability for somebody that adopts. You can't carry it forward. You just get, if you only owe $2,000 in taxes, you get basically a $3,000 refund for adoption. Dependent care, they changed that. It increased the credit amount from 35 to 50% of child and dependent care expenses. If you've got children or grandchildren that this affects, this is something they should take a very close look at. The whole entire child care situation has changed dramatically under one big beautiful bill. American Opportunity Lifetime Learning Credit for people that go back to school. Yeah, they've tightened the requirements on this. They want to see EINs for the school. They want to know that it's real. They want accredited programs. This is part of the administration's crackdown on colleges. This is part of that crackdown that they're trying to put additional compliance measures in place to make sure that if people are claiming education credits, it's going to actual real accredited universities and programs, not to, these fly-by-night organizations. And a lot of those did exist. It seems that they're kind of going out of business now for some reason or another. So there were a lot of unaccredited programs, and they were really gouging people in addition to the accredited programs gouging people too. So for those of you with children or grandchildren in college, it's not cheap. Tax Cuts and Jobs Act, the individual income tax rates are essentially going to be just extended. They did make one change. For the 10%, 12%, and 22% bracket, for anybody that's retired, this will probably affect them. They are going to start adjusting that for inflation going forward, meaning the income tax, the brackets will bump up for inflation every year. So you might see, if you're taking RMDs from your qualified accounts, you might see your tax bill actually go down in the future. The inflation adjustments to the code might exceed what your stepped increases for your age-based distributions are. So that's something to keep pretty close eye on. For those of you that have children with special needs or grandchildren with special needs, they made some changes to the ABLE account contributions. There are credits that increase from $2,000 to $2,100. So they are trying to encourage people to use more of that. They did permanently, this is a strange one that I didn't expect to see in here because of the negative press that the administration's getting with their handling of the student loan issues. They permanently extended exclusions from gross income for student and private education loans that are discharged on account of death or disability. What that means in plain English, you don't have, if it's discharged because you die or because you're disabled, you don't have to pay income tax on that discharge. That's actually a pretty big deal. They were fighting for that for a long time. They did get it, and they had it in there from 21 through 2025, but it was set to lapse at the end of the year. So they made that permanent. So that's in the tax code now until somebody actually takes it out. Mortgage interest deduction is actually a really strange one that they made changes to. So you can't deduct mortgage interest on your home equity line anymore. So that's over. They had temporarily suspended that, and there were always workaround rules that you could say, well, if it was for an improvement on my house, I could deduct the interest on it. They just said there was so much abuse, I think, with people buying cars and paying for college and doing other things on there that I think they just finally put an end to that. The deduction is now up to $750,000, which was a slight increase from where it was before at, no, it was at 750, sorry. You have a child tax credit, which was increased. Now it's at $2,200 per qualifying child. However, they want Social Security number reporting. So this is part of the anti-immigration and the crackdown on immigration. They won't allow people unless you can show an actual taxpayer ID number for the dependent child. You can't take the credit anymore. I don't know how much of that was being abused. It's in there now. Standard deduction. So standard deduction now is permanently increased from 12,000 to 15,750 for individuals, and from 18,000 to 23,625 for head of household. State and local, this is the SALT. This is one that was a huge fight, if you guys remember it, increase. Now, this won't really affect people in Pennsylvania much. I doubt anybody's paying quite this much in state and local tax, but some people do, I suppose. Increases the SALT deduction from or to $40,000 for 2025, so this tax year, and $40,400 for 2026. And then every year, 27, 28, 29, it will increase to 101% of the prior year, meaning it's going to get up pretty high. Well, it's already pretty high at 40,000. It's going to revert back to $10,000 though in 2020, 2030. So this is something that if you own property that has residential property in particular that has a very high property tax, you want to definitely pay attention to this. There are phase outs. They begin at about 500,000 of modified adjusted gross income in 2025. They do increase too. And the phase outs, so even if you phase out completely at like $1 million a year, you can't go below the $10,000 deduction. So basically they've made a floor for the deduction. So you get even the billionaires are going to get $10,000 deductions now. You can agree with that or disagree with that. We're not here to debate that one tonight. Auto interest is something that probably isn't going to affect a lot of people, but it might. So you can deduct the purchase of applicable passenger vehicles as long as they are, I believe, made in the United States, or they have final assembly in the United States at least. You can take up to $10,000, and it's phased out by $200 for every $1,000 of modified adjusted gross income in excess of $100,000 for a single filer, or $200,000 for joint filers. That's a little bit of a mouthful. Know this: if you're not making over $200,000 a year as a married couple, and you have a Chevy and you're paying interest on the loan, you need to talk to your CPA if you're not getting a deduction for that, because you should be. They put a itemization, or rather for itemizers, they put a 0.5%, so 50 basis point floor on the deductions for charitable contributions. They didn't really monkey around too much with that. That's something we kind of expected them not to change. There is no tax on tips now. There's a new code section, $25,000 deduction, and it phases out for $150,000 for single filers, $300,000 for joint filers. It's kind of an interesting credit, or interesting deduction rather. They don't really have a lot of regulations on this right now, so we don't really know what other rules they're gonna tack onto this. But it does actually seem like it might do something for people that are waiting tables and not making a ton of money. It's hard to tell. Right now, it seems like it might. There's a deduction of 12,500 for qualified overtime pay. That's for single filers, 25,000 for joint filers. And Trump accounts, this is another one. So those of you that have grandchildren and you want to start thinking about putting money some other places, my guess is they won't be called Trump accounts forever. They'll call them something else at some point, so don't worry about that. They are effectively like an IRA, or like a 529-ish type account. All we know is that they only apply to people that are born between December 31st of 2024 and before January 1 of 2029. The government puts $1,000 into those accounts, and then annual contributions are limited to $5,000, and then they're going to index that for inflation, so that number will go up. And that doesn't include employer contributions that come from the employee's gross income. I don't even know what that means. I guess that means if you defer from your paycheck into these accounts, there's no contribution limits. That's how I read that. I've never seen anything written like that before. So regulations pending. We haven't seen anything on that. There are certain sale of certain types of farmland. There's capital gains. You can basically, if you own a farm and you sell it, and if it qualifies for this treatment, you will be able to effectively treat that sale as an installment sale and claim the taxes over a 4-year period rather than claiming them in year one. Obviously, still, if you claim installment method on the sale, you will still be able to claim taxes over the course of that installment sale agreement. But this allows people that sell a qualified farm in year one and get all of the money for it. My guess is that this has something to do with data centers, if I had to guess, but it allows them to spread their capital gains tax liability out over four years rather than having to pay it all in 1 year. And I can almost guarantee you that that's what that's for. So here's our in memoriam, all the stuff that they took away. We no longer have the energy efficient home improvement credit. There was a lot of alleged abuse. I think I think they did actually show there was abuse with that one. The residential clean energy credit, I don't really know if I don't know that. The energy efficient home improvement credit was the one that everybody went after. The previously owned clean vehicle credit, the clean vehicle credit, those are your credits for electric vehicles. Those are going away, which is also causing shares in every electrical vehicle stock to crash, except for Tesla for some reason. Can't figure that out. New energy efficient home credit's gone. Miscellaneous itemized deduction is gone forever, which I don't like because we used to be able to. We were one of the very few lawyers that could put our legal fees under tax advice, and then it was deductible under the miscellaneous itemized deduction, but no more of that. And one that I am missing because I ride my bike to work, because a lot, is the bicycle commuting reimbursement. I loaded a bunch of, expenses into that, basically every time I had to fix my bike. So that's gone now too. Personal exemptions are also gone. The reason they got rid of personal exemptions is because they upped the standard deduction. So there is a reason for that one. The other ones, I'm not entirely sure. It's not readily apparent. The clean vehicle credit could have been because of the Musk-Trump fight that was going on in the middle of summertime. So we don't really know what the reason was behind that, but that went into effect during the Biden administration, and they have officially yanked that. So I'll end it with the kind of controversial. They got rid of the $200 tax stamp for National Firearms Act acquisitions. So machine guns, suppressors, short-barreled shotguns. You don't have to pay a $200 tax stamp anymore. You just have to go through the background checks with the ATF and with the local law enforcement or Pennsylvania State Police. And now you can own those things, but you don't have to pay the $200 to the federal government.